Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, I welcome you to the topic today for the day is accounting for derivative. Comprehensive guide is going to be. Let's understand this in a detailed format. Accounting for derivatives. Now, in the regular course of the business operations, organizations are exposed to risks, market risks, such as the interest rate risk. You have FX risk, that is the foreign exchange risk. Then you have the commodity pricing risk. So this risk gives rise to the income volatility, and as a result the organization often will take some action to mitigate or economically what we say hedge against such exposure using the derivative financial instruments like forwards, futures, options, and swaps. In addition, some of the organizations may enter into the derivative contract for speculative or trading purpose. Now, in this tutorial, we are going to see how we account for the derivative transactions in the books of accounts. Let's understand the derivative. See, there is the first one, that is the forward contract. What exactly happens in forward contract? See, a forward contract is simply a contract between the two parties to buy or to sell an asset at a specific future time at a price agreed today. Like, so let's say there is a company A that contracts with company B, let's say on October 1st of October 2016 for the purchase of, let's say, 10,000 Tata Steel shares at 440 share price on 1st January 2017. So in this case, the irrespective of the price that is going to be on 1st January, the stockbroker has to sell 10,000 shares of Tata Steel at 440 on 1st of January. Then the company A will be at the profit. Otherwise, the stockbroker will be at a profit. The second is the futures contract. On a simple sense, futures and forwards are essentially the same, except that the future contracts happens on a future exchange and which acts as a marketplace between the buyer and the sellers. The contracts are negotiated at the future exchanges, which acts as a marketplace between the buyers and the sellers. What we say, the buyer of the contract is said to belong to the position holder, and the selling party is said to be the short position. Here it's the long position, here it's a short position, as both the party risk their counterparty walking away if the price goes against them, and the contract may involve both the parties lodging a value of the contract with a mutually trusted third party. Like, for example, continuing the above example, if the contract has to purchase the steel of Tata Steel is entering on a future exchange, that is a clearinghouse, and both the parties have to deposit, in this particular scenario, an amount for honoring the contract, and the contract is the futures. Here futures are nothing but the forward contract, except that the third party here is there between to avoid the risk of any denying of honoring the contract. So in case of future, even if the price of the Tata Steel on the 1st of January 2017 went up to, let's say, 600, then also the stockbroker in that scenario will have to sell the 10,000 shares to the company A at 440, and the risk of denying by B is eliminated, as the clearing agent or the clearing house exchange is there between the margin amount, because the margin amount has actually been deposited, just to cover that. Third is the option contracts. In option contract, which gives the buyer the right, which is actually the owner of the option, the right but not the obligation to buy or sell on a specified date depending on the form of the option. Like, for example, continuing the same example, in case of the option company purchases an option to buy a call option, let's say the Tata Steel, the same example, at 440 per share from the stockbroker B at an option price over here. Let's include the option price over here as $20. Okay. In this case, the denial by B is not possible, as company A bought the right but not an obligation to buy the share. Let's say on the 1st of January 2017, if Tata Steel shares are operating at let's say $300, then company A is not at all obliged to buy the shares from B at 440 per share. So the option will actually lapse. So in this case, the maximum loss for company A here is the amount of the premium that they are paying, 20 per share, and profit of company A is unlimited, and the loss for stockbroker B is unlimited. That's the difference. Now the accounting part. See, basically, let's take an example only to understand how to calculate the profit and loss on derivative transactions. in this example, let's take the exercise price. I'll take on the next sheet and let's take the example. Let's take over here the exercise price as 100, call option premium as $10 per share, and the lot size is, let's say, 200 equity shares. Now we'll find out payoff and profit and loss of the buyer and seller option if the settlement price is, let's say, 90, 105, 110 and 120. So the call option, the equity share of the profit and loss for both the options, seller and buyer, will go something like this. This is going to be the scenario in this particular in the case of 90, 105, 110 and 120. This is how the whole table that will be formed for all the scenarios. So in the same case, our entries, the journal entry that will be something like this. It will start with the call option. We have all the details that needs to be operated here. We can start with what we call as the solution part, which goes as the bank account. The first entry is the bank account debit to the call option obligation account credit, and the amount will be over here 5,000 and 5,000. Second entry on 1st February, the entry for the same will go as the call obligation account debit. The fair value gain account will be credited to the extent of 1,000 in both the scenarios. Then on 31st December, the final date, the call option obligation to bank account, that will be 2,000 and 2,000. On the exercise date, the cash settlement is going to be equal to 5,000 minus 2,000 minus 1,000 here instead of this. Yeah, so this is how your settlement on the settlement date things are going to be the case. Now in case the transaction is settled on 31st of December, your entry will go something like this. Your call option obligation account will be debited, shares of X Limited will be credited that you are buying, or the Tata Limited share, whichever you want to, 2,000, 2,000. The calculation is going to remain the same, is equal to 5,000 less 2,000 less 1,000. Now, the gross shares, in case of the gross entry, the entry is going to be the bank account debit to the call option to the extent of 5,000. There'll be no entry on the 31st March, but on the 31st December, it's going to be bank account to shares to the X Limited shares to the extent of 1,02,000. So in this fashion, the entries are going to be recorded for the call option. In the similar way, in the put option, also the same entries, the same sort of entries will be recorded, and you just need to reverse this example, the example that we have taken. Just reverse the case and you will get the answer. So this is it for the accounting for derivatives. I think you have got a clear idea regarding all the situations out there. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you everyone. Cheers.